We're very selective about what other builders we want to do business with, because not all of the builders have bought into using land banking as capital efficiency. There are still those that view risk mitigation through a historical lens, and those are not the builders we want to do business with.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. Joining me for this week's episode is Darren Richman, President and CEO of Millrose Properties. Millrose is a REIT that acquires and develops land for home builders, and Darren is with me to explain the business model and more. Darren, thanks for coming on the REIT Report.
Thanks for having me.
Darren, let's start by talking about why Millrose Properties was spun off from home builder Lennar in the first place, and whether any blueprint already existed for your business model in the public markets.
Yeah, Millrose was spun off from Lennar in February of 2025, and it was really done so for Lennar to turn itself more into a asset-light home builder, which allowed it to concentrate on the building of homes, the consumer end of that, and it allowed them to push the land development onto the balance sheet of someone else like ourselves. And land banking has been around for a long time. We're not the first ones to do it, but it really helped Lennar to clarify their own business model. And we've seen this done while there was no blueprint per se. We have seen this done in other sectors of the economy, notably in hospitality and in some of the consumer restaurant businesses.
Right. And can you explain more about the process of working in conjunction with home builders to secure land for development and how the revenue stream operates?
Yeah. So essentially, we collaborate with home builders where they identify land. This is land that's already entitled and approved for construction. They bring that land to us and we evaluate it, taking their investment committee memoranda. We put it through our own due diligence and data sets. And if we agree to buy that land, essentially we'll buy it on their behalf and option it back to them, where they have the option, but not the obligation to take that land down. And essentially we're paid a fee, which is called an option premium, option rate, for the time that we own the land. While that land is being developed, they will pay us that option fee. And we'll have a pre-committed takedown where they'll agree to buy it back from us at a predetermined price. Usually we'll put $1 to buy the land, $1 to improve the land. The home builder will buy the land back from us at $2, but during that period that the land is being transitioned and we own it, they're going to pay us an option fee. And so that forms the basis of our revenue. And that revenue is very consistent because we know exactly how much the home builder is going to pay us. They're going to pay us that option rate over the time we own that land. And there is a time schedule that they live by. So when we enter into a deal to buy land on their behalf, they also enter into an option agreement, which talks about not only the rate, but the takedown, how often they're going to buy land from us over what period of time. They enter into a development agreement, which means that they're responsible for, during the period we own that land, to develop that land, to bring it to its intended use as a home site. And even if they walk away from that option, they're still obligated to develop that land. And if there are any cost overruns, they're responsible for that. And then the third agreement we enter into, in general, is a pooling agreement. And so what that means is that not only are they optioning one community from us, but if they reject that one community, in general, they lose access to the other communities that are in that pool. And it doesn't mean that a builder can't walk away from a community. It just raises the breakage cost associated with doing so. And it gives us a lot more confidence in the sanctity of that those options will be maintained.
So if they did walk away from that deal, then you would put that land on the market?
That's correct. Yeah, we would seek to sell that land to another home builder. That does happen from time to time. It's actually more rare than I think most would expect, that a home builder actually walks away from the land. We've actually not had one home builder walk away from any parcel for as long as we've been doing it, not just at Millrose, but at Kennedy Lewis. We've historically done land banking. So over the last 5 or 6 years we've been doing land banking, not one home builder has walked away from any parcel of land that we've land banked for them. Doesn't mean it won't happen, but it means that over a time we've done this, and we own about 250,000 home sites, and we've owned much more over time and cycled through it. We've not had one home builder walk away. And that includes over the last year where many would think we've been in a housing recession, if you will, and we haven't had one builder walk away.
That's a great track record. So the home builders source land, come to you, but is it ever the case that you would stumble across a particular property and reach out to the home builders and suggest, why don't you look at this land?
We don't. We play more of an independent role in the industry. It's a very competitive market for land. The one thing that holds housing back from a production perspective is that it's very hard to get land approved for development. And it is the scarce resource associated with housing. And so we don't find ourselves on the prowl for land and then bring in a home builder. It works in the exact opposite. They have division folks and land folks that are in the markets every day that are looking to tie up land that it has been through the approval stage or is going to go through the approval stage. Again, we don't take that land to purchase it unless all the entitlements are had and all the approvals for building have been obtained. And only then will we buy the land on behalf of the home builder. So we know who our customer is up front. It's the builder who we've entered in these contracts with. We know the time frame we're going to own the land because we have these takedown schedules with them that the home builder is obligated to live by. We know the price at which we're going to sell that land in the future. And so there's a lot of visibility around our business model. And that's really what we sought to create when we created Millrose, is taking a process that historically has been lumpy, that conversion from land through the stages of development to a home site has been a long and lumpy process. We've broken that process down. Our balance sheet allows that land to go through this lumpy stage, but our income state has created a very visible stream of revenue because our revenue is really our land that we own and the development that we've invested times the option rate. And so we have a lot of visibility as to what our revenue is going to be. All the way down, our costs are reasonably fixed. And so our revenue translates with great clarity into our net income, and we pay out 100% of our net income as a dividend.
And Darren, can you talk a bit more about land availability and which geographic markets you're most likely to be working in?
Yeah, land is very difficult to, again, get approved for development. We operate in all the markets that the major home builders operate. They call them the smile states. I'm sure you've heard that before. Everything from California down through Texas, around to Florida, and then up through the mid-Atlantic. These are all states where they have in-migration. There's generally an imbalance between housing and job growth, and they've benefited from very good, not just job growth, but in-migration. So these are the markets in which we operate, and we have a very robust technology platform that we have created ourselves. It's all proprietary. And this really does help to inform our due diligence by taking real-time pace and price information from the 250,000 home sites we own as a firm, about 140,000 inside of Millrose, to make real-time decisions about where we want to be invested, which markets we want to be overinvested in, and which we want to be underinvested in. But where we operate is really where the home builders operate themselves.
And you've now reported 3 separate quarters of earnings. Are there particular themes that you're talking about with investors, and how well do they understand this business model?
The business model is really, at the beginning, was very novel. And I think there was a great deal of skepticism of how could you take a land, which again, historically had lumpy operating metrics, put it into a REIT and turn that into a publicly traded company. I think by this point, the market has gotten more comfortable with our business model, the stability and the consistency of it, the nuances and how those nuances fit together. At the beginning, there were really three things that we were clarifying for the market. One was the bad land that was spun off from Lennar. There was an unfortunate Barron's article that hit just after the spinoff, which questioned the quality of the land that was being spun into Millrose. We've dispelled that at this point. In the ordinary course, we have cycled through hundreds of millions of dollars of land with Lennar on the schedules that were pre-configured at the time of spin. And we've bought a like amount of land on their behalf to replace the land that they had purchased from us. So that flywheel of our relationship with Lennar has proven itself quarter in, quarter out. The second thing we had to clarify was, could we grow accretively with third parties? And there was a lot of skepticism around that. Yes, even if we do believe in the business model and the flywheel with Lennar, we don't believe you'll be able to grow was a notion. And we've proven that we can not only grow accretively and drive the yield up at Millrose, but have done so responsibly. So we put out, our initial goal was to grow with third parties at about $1 billion for 2025. We increased that to $1.5 billion with a stretch target of $2 billion. I think we're the first company I know of who's ever put a stretch target out in the public domain. Still a little embarrassed by that, but we did. And I'm proud to say in our last quarterly release, we acknowledge we're going to exceed our stretch target. We put a new target out to hold ourselves accountable to. So not only have we grown accretively, and I will say 97% of our portfolio today benefits from those pooling contracts. So it says that we've grown with third parties, we've grown accretively, but we've grown responsibly by maintaining the quality with getting cross-collateralization. And again, I will identify cross-collateralization does not mean a builder can't walk away. It just means that it's just increased breakage costs to do so. And then the third thing that we had to clarify and prove out over time was, how does this collateral perform over a cycle? Whether we like it or not, we've been in a cycle now for more than 12 months. Every quarter we reported, there were sector headwinds that we've been dealing with. Affordability has been a challenge. Home pricing has been a challenge. Pace has been a challenge. And again, our portfolio has held up rather well. I'd say extraordinarily well, given the backdrop. And so the market has had an opportunity to see how this collateral performs over time. And I think where we're going now is less about those three maybe items that we had to work through. The market has now grown to appreciate the consistency and the visibility of the business model. And it's no longer about valuing us relative to book value, but now the conversation is shifting as we speak with investors about, where should we trade on a yield? What yield do investors demand relative to the risk of the business model? Which is a good conversation to be in, because it means that book value is no longer the ceiling. It's more what yield. And we've said this, at steady state, we should be producing a 9 to a 9.5% yield. The market is slowly coming to the realization that might be too high relative to the risk, which means we will trade through book value. And there's been a number of analysts who have, or at least two analysts in particular, that have launched coverage on us with stock prices well in excess of book value. So they kind of buy into that same narrative that it really comes down to yield relative to the risk. So we are quite pleased as to where we started, where we are now. We don't take it for granted, and we know we got to continue to execute in order to hold the ground that we've gained.
And Darren, just to clarify, you're working mainly with Lennar, but other home builders as well. Are these other builders, are they as big as Lennar or household names?
Yeah, they're definitely household names. To date, we work with 12 different counterparties. So it's Lennar plus another 11 counterparties. 6 of the counterparties are in the top 25 home builders in America. So, all of them would be household names, but about half of them are in the top 25 of the largest home builders in the country. And we expect to continue to convert new clients over time. We become very selective as to which builders we'll do business with. And if you allow me just a tangent a little bit, Land banking has historically been used by builders for risk mitigation, where they were prospecting out in areas where they thought there might be housing growth. They would tie down land, and if that growth didn't materialize, they would walk away from a contract. The more modern form of land banking is about capital efficiency, where a builder is looking to clarify, like Lennar, looking to clarify their own business model, looking to separate the opco from the propco, increase asset returns, and really clarify their business around a consumer-facing entity and divesting themselves of some of those inputs that don't help the consumer-facing business. And so the more modern form of land banking is really about capital efficiency, taking that long lived cash conversion cycle of land development and putting it into the hands of somebody else. And so the more modern form of capital efficiency, you have builders that are more willing to cross collateralize those communities because they believe they're going to take down this land almost no matter what the environment is. I'll say it again. It doesn't mean they can't walk away, but they're obligating themselves to just a higher breakage cost. And those are the type of builders we want a relationship with, are the builders that are looking for capital efficiency to streamline their own business model and are looking for a partner to help achieve that goal. And I start out by saying I'm going to go on a tangent. It's a long way of saying those are the type of clients we want to do business with, the ones that are looking to partner with a land bank versus use a land bank to push risk off and to just walk away at a whim. So we do business with 12 distinct counterparties today. We're very selective about what other builders we want to do business with because not all the builders have bought into using land banking as capital efficiency. There are still those that view risk mitigation through a historical lens, and those are not the builders we want to do business with.
And Darren, do you see this new business model perhaps putting a dent in the whole shortage of housing in this country?
We do. We're not going to help alone. The shortage of housing is really about, again, the key ingredient. The scarcest of all resources is land and getting land entitled for approval and development. And that is what is holding back housing. So the more folks that can buy land and warehouse land for the benefit of future production is going to be part of the answer to bringing more housing online more quickly. We are part of the solution set, but we are by no means the only answer to the shortage of housing. Part of it is a supply issue of bringing land into production, and part of it is a demand issue with answering the issue of affordability. And I know that there's a lot of discussion where you live in DC focused on both sides of that equation, which I think is smart. And I think it's very good for the industry.
Darren, this has been a great introduction to your company, but is there anything else that you think listeners should know about your strategy or anything related to Millrose?
Yeah, look, we're very proud of what we've achieved in a short space of time. We created something a little bit out of thin air that allows the home builders to separate their two businesses into an opco and a propco. This separation has been routinely done in other sectors and done very favorably. It was a long time coming. These are two businesses that don't necessarily need to be together. And it takes me back a little bit to the auto industry in particular, where you had folks like Ford that used to control steel making and metal fabrication. And it did nothing to help them build a better car or respond to consumer demand. And over time, they divested themselves of these inputs that created a little bit more cyclicality of their business. And so they were able to reduce cyclicality, increase their asset turns, and ultimately reduce cyclicality and generate and be valued at much higher multiples in the market. And I think we're in the early stages of doing that very same thing for the home builders by separating the opco from the propco, clarifying their business models, increasing asset returns, ultimately should lead to a re-rating for those that pursue this land light strategy.
Thank you so much for your time today. It's been great.
Thank you very much.
And to our listeners, if you enjoyed this episode, please subscribe or leave a review on your favorite podcast platform.